Good day and welcome. Today we're going to take you on a financing bootcamp.
We'll discuss the different types of financing and what you can do to secure financing for your company or your project. Now let's get down to business.
Wonderful good afternoon, everyone. Dear members and friends, welcome to our workshop series on wastewater compliance in the Philippines. My name is Tobias Peterson, the Director for Dual Training and Education at the German-Philippine Chamber of Commerce and Industry, in short, GPCCI, and I will be your moderator and facilitator for today. And with the recent enforcement of wastewater standards in the Philippines, companies face great challenges to ensure compliance. The workshop series is in line with the expert program of the German Federal Ministry of Environment, Nature Conservation, and Nuclear Safety, and aims to address the compliance of small Philippine companies, of small to medium Philippine companies, and provides you with, for today's session, however, we will focus on the green financing aspect of everything, as well as giving you possibilities for project bankability. So I'm also very pleased to introduce our esteemed certified trainer for today, himself a certified green finance specialist, one of the most important voices and respected opinion makers and advisors in the low carbon transition and green finance mainstreaming spaces in the Philippines and in the wider Asia Pacific region for many years. Please welcome our trainer, Marlon Apanada.
Thank you, Tobias, and welcome, friends, colleagues, and fellow lifelong learners. And I hope you and family have been keeping safe, healthy, and well amid these challenging times. Over the next 2 hours, spread across 2 modules with one break in between, we'll aim to have a productive, dynamic, and insights-filled learning session today. Something of a topic because many stakeholders conflate and get confused with the different branches of what green finance is. And so we start with, next slide, please, slide number 8. We show here 3 specific definitions. The definitions of green finance, sustainable finance, and climate finance. To be blunt about it, their definitions overlap. From the most broad to specific, we have sustainable finance, green finance, and then climate finance. So climate finance, when you talk about climate finance, it refers to solutions, financing solutions, whether local, national, or transnational, so cross-border, drawn from either public, private, or whatever alternative sources of financing it is, that seeks to support mitigation and adaptation actions that will address climate change. So let's go later with the different nuances of each definition. When you talk about green finance, it now covers a gamut of financial services and products designed to promote the flow of finance towards green economic activities and projects that may or may not be climate aligned. Aside from financing to promote climate change and mitigation, green finance also covers environmental improvement and efficiency improvement in natural capital preservation and resource mobilization. Sustainable finance, on the other hand, is broader, refers to the provision of finance into investments taking into account environmental and social and governance considerations. So it's not only about environment, it's not only about climate, it's also about social and governance considerations. It includes a strong green finance component that aims to support economic growth while reducing pressures on the environment, but it also encompasses increasing awareness of and transparency on the risks which may have an impact on the sustainability of the financial system and the need for financial and corporate actors to mitigate those risks through appropriate governance. So next slide, please. So to better understand this whole taxonomy of sustainable finance and then the overlaps therein between sustainable, green, and climate finance, we have this chart which shows the taxonomy of relevant financing terms. Finance which only tackles climate change mitigation is called low carbon finance. climate finance covering both mitigation and adaptation, while green finance also covers other environmental interventions such as biodiversity protection, conservation of natural resources, and pollution control and mitigation. Drawing a line between green finance and sustainable finance is more difficult because sustainable finance usually takes environmental, social, and governance impacts into account simultaneously. There's a growing awareness about why the banking sector, why financial institutions are more open to financing green and are actually in the trajectory of going green, as we can see from examples later. It's because of these risks. There are two climate-related risks. One is the physical risk. As you can see, when Typhoon Yolanda hit the eastern seaboard of the Philippines, many of the asset values of properties in that area plummeted because they were destroyed. If you're an asset manager with a portfolio of properties in Florida and that is in danger of the next super hurricane, then that's a risk. If you include the wildfires in California and the heat wave that are happening in the West Coast, all of these are subject to physical risks because these are the risks resulting from climate change, which can be event-driven or acute or longer term, which are chronic, that may cause direct damage to assets or indirectly through the disruption of the supply chain. There's also transition risk, which most banks are trying to be very well aware of, especially that the Central Bank of the Philippines, BSP, issued the Sustainable Finance Framework, officially recognizing transition risks as part of systemic climate-related risks to the financial system. An example of this is the ADB-backed Asian Development Bank first climate bond in Asia and the Pacific in 2016, where ADB provided credit enhancement to the Tiwi Macban geothermal energy facilities. ADB's credit enhancement, is in the form of guarantee of 75% of principal and interest on the bond. There's also a risk mitigation green finance delivery instrument in the form of insurances. Climate insurance or green insurance would not necessarily require additional finance since the insured can generally finance the insurance program. So they can facilitate risk reduction and prevent practices and preventive practices by directly rewarding investment in risk reduction by lowering the premium. Crash course, like a bootcamp of terms. We can go from terminology and taxonomy into Philippines applicable cases by proceeding with Philippines green finance windows. We just define what sustainability bond is, and it's really just green plus social. Anything that's green and anything that's social is equal to sustainability. If you are serious about financing wastewater management solutions via the green bonds, a huge resource will be the ASEAN Capital Markets Forum, or ACMF, which is a forum which comprises capital market regulators. In the Philippines, it's the Securities Exchange Commission, or SEC, from ASEAN countries. The ASEAN Sustainability Bond Standards intend to provide guidance on the issuance of ASEAN Sustainability Bonds, which are bonds where the proceeds will be exclusively applied to finance or refinance a combination of both green and social projects. If you are serious with projects and you want to tap the bond market, especially the green bond market, it would be great to talk to the Securities Exchange Commission because they have been rather active in the ASEAN Capital Markets Forum.
Marlon, thank you very much. What challenges did you encounter with project bankability? Or maybe don't you even have experience with project bankability? That is also a valid question. Kindly put in your answers.
Bank loans and bonds are very similar. So the main two differences are, first, the length of the borrowing and what rights the lender has if the company goes into bankruptcy. Those are the two main differences between a bank loan and a bond. So bank loans are often much shorter in maturity than bonds, and banks usually get their money back before bond holders. On the other hand, the key differences between bonds and equity is that most equity has voting rights and participates in the growth of the company. So they share in the upside. Whereas debt, which a bond is a form of, has neither voting rights nor the ability to participate in the company's growth. However, debtors do have the ability to call in the administrators if the company defaults on a payment or breaks a covenant, which are legally binding promises made by the issuer to the investor in the prospectus and possibly close down the company. They also have an earlier call on the company's assets. So if the company does default, the bondholders often get something back while the equity holders get nothing. So indeed, this scenario, in this scenario, the bondholders usually end up owning the company. So in bond market language, this means that the debt holders rank above or higher or senior to the equity holders. So when you go deep into finance, including green finance, you will hear the word senior and junior often, and it's just a term of who ranks higher in terms of priority in getting something. Since I cannot discount that term of arrogance earlier, banks will be less arrogant if you're able to show the cash flow of your project, because it is really, truly the indicator of project attractiveness. When one of the biggest mistakes that organizations, developers, or even any concerned public or NGOs that want to go through any kind of projects, whether it's renewable energy, energy efficiency, or wastewater management, is their inability to show where the cash flow is coming from. Because they don't know what the business model is, right? So this chart, which shows cash flow as indicator of project attractiveness, shows the flow of cash in and out of the project. Once the operations, equipment replacement, and tax payments are deducted from the total cash inflows, so from your revenues, we get the operating cash flow, right? From the operating cash flow, we can set aside a percentage for expansion investments and get the net cash flow. The net cash flow then becomes the pool of cash you will be using for your financing payments, such as the payments of interest, and what is left is the free cash flow, which may be allocated to pay out owners, increased liquidity, or reduction of capital share. So when you go to a bank, they will always talk about the DSCR, the debt service coverage ratio, which is a ratio of your debt and how much is your free cash flow. And if you can't answer that question, maybe your relationship manager may appear arrogant because they spent time and talk to you thinking that you know about the cash flow of the project. And I guess that's one of the things that with the nascent wastewater management solutions, business models, which we as an industry have to work with together. Because what is really the business model there? Is it cost savings? Is it some form of service fees? Is it some avoided cubic meters of waste going somewhere? Is it the productive use of wastewater as your feedstock or some form of raw material? So that becomes part of the things that you have to consider when you do financing, and especially green financing, because the basics of finance, which is all about the cash flow, will come into fore.
All right. Marlon, thank you very much